So, welcome to this. Right now, it seems a very micro webinar. If anyone has a question in any time, so you can always raise it. You can unmute yourself and ask the question. I hope that is okay. So, anyway, basically, we always start with the aspect of investment, and we say that what are we investing for? Why should we invest for? And I have also, at plenty of time, I have said that this is the only way you can actually prepare your corpus for future. This is the only way you can keep up with inflation. And this is one way we can achieve financial independence. And when we talk about financial independence, nowadays you must have heard it all over the media, everybody calling it that, yes, financial independence, and somehow relating it with retirement. It does not mean that. Financial independence is an independence where you decide that how much do I need, and when what is will be the state at which I will not be working for money really, but working for what I like. This is very important because we all have a lot of ambitions and desires which we do not really fulfill during our working life. We sometimes have to take up careers for various reasons which we do not really opt for. Like, I never wanted to become an engineer, but in my time, you were told what to do, and I was very happy if I had been able to study history, geography, and economics. And doing something like engineering was a very intensive thing, but anyway, we did. So it is the same way. A lot of people have their hobbies. A lot of people want to travel around. They want to become photographers. They want to become travel, buffs and everything. Become writers. 2, 3 people I know who are very good artists. So all these things are possible to do only when you achieve a certain corpus. So in this corpus, I had discussed this one. I had been sharing this Excel sheet with you earlier. So I'll just share it again with you so that you're able to see what I'm trying to say. So this was a screen which says that how much actually, in theory, you could save. In theory, of course. This Excel sheet, if everybody can see it clearly, this starts from the age of 19 when a person is a cadet. And the earnings in this column C is actually for a dry cargo vessel, which was there about 2 years ago. I'm not aware if the salaries have gone up, but let's take even the minimum. And now, how much to save to invest? Because, like I have already told you before, what is the difference between saving and investment? Saving is any money which you will keep under the mattress, in the piggy bank, in the bank locker, on which you may or may not get an interest. You may not get a fixed interest, but you're keeping the money. The money doesn't change its form. Now, moment you use that money to buy anything from land, gold, shares, art, uh, these vintage artifacts, antiques, and gold back again, jewelry, you have changed the form of money. In fact, even using that money and keeping your salary in dollars in India, when you keep your salary in dollars in India, it would be called investment. If you kept the salary in US, I would, in my definition, call it saving. This definition of investment is my own, and I have developed it myself. You will not find it in any of the economics books. So why I call that money as investment? Because now it has changed form. There is no possibility that you can use that form to buy a cup of tea or a coffee or a dinner even. You will have to sell that. And when you have use that to change form, it is possible that you will get a benefit out of it, it will appreciate, but there is an equal possibility that it will not be appreciating, it may go into a loss. So that is a risk, and that is the only risk which is accompanied with uh, investments. You do not know whether what would be the state. So you have to take calculated measures in different form after selecting the correct avenue for investment. So let's go back to this Excel sheet again and see that how much a cadet in 7 months of sailing on a dry vessel would earn. And since you are going to be non-residents, let's assume that you have saved your 30, actually it is 33%, but let's call it 30% of your annual earnings you've saved as tax. So now if you just invested that and later on you kept investing like this, I have assumed that this amount is growing at the rate of 10% only. Every year, just 10%. Uh, in investment, when you do it, it's not really 10% every year. It could be more than that. For 2 years also, you may not get any returns. But when you will take an average of 4 5 years or up to 7 years, you will get an average of about, I would say, 10 to 12 or 14% in mutual funds. Now, then he gets down for his exams and he utilizes this money for his exams. Again, he starts working as a junior engineer or a junior watchkeeping officer. And again, he starts earning this, investing 30% of it, and goes up. And again, at the age of 27, he has to get down for the exam again. In between, of course, he has to spend money. But this is the minimum that he was able to save and invest, just 30% of what he was earning. I'll just take a break and I take a detour and tell you a mail about that. I have a question about a cadet who said, I don't have enough money to invest as I want to buy the gadgets that I have always wanted to because I come from a middle class family. So I'm going to take up this question later on. Again, at the age of 27, he has an exam and he's going to use whatever amount. Now, just remember that remaining 70% is the money that he always had with him, which he could use for his expenses, for his evening exams, or whatever. So the yellow figures, wherever are they are, I have not filled them for you. Again, 28, he starts as a second officer, third engineer, and he starts earning all these figures, which are again for a dry cargo for last year and at an exchange rate of 2 years ago. These are the minimum figures that one can. And one again starts growing up, and we assume that he will take this much time to move from fourth engineer to second engineer, chief officer at the age of 30. We hope that he becomes the chief officer or second engineer. And his take home at least would be 32 lakhs at that time, out of which he saves this much. And in the F column, in this column, you can see what is the actual level that we are talking about. You see, this is the way he is growing. And of course, somewhere around this line between chief officer or captain, because nowadays people are getting married earlier. So he would get married somewhere along the line. But again, he already has a 70% salary, which he is not paying, using to pay tax, which he could still continue with this. Whenever you have to buy a home or for nothing except a home, you could go in for a loan also, because it always pays to pay a little premium to keep your liquidity. It is never a good idea to not take a home loan, or if you have taken a home loan, to actually pay off completely. As you have seen, the rates keep reducing. You can restructure the home loans and you can keep your liquidity intact. Now, from here onwards, once he becomes a master or chief engineer, there's only it's like as I have written in my book, it is received full ahead. We just keep moving. We just keep going about that. Ship is moving with full power and there's nothing much of deviation required till you reach the next port. So I just took this earlier up to this age of 50, that how much would he be having at the age of 50? And if we have not deducted anything, which you of course have to deduct from here, but if you could manage to save just 30% at every stage which you earn and not increasing it by 10%, what the financial advisors in the market tell you or what they stock on the television, then at the age of 50, you stand with 9 crore, 9.5 crores. And then it occurred to me that what if a person decides not to retire at that time? So if he does not want to retire at that time, assuming that from the age of 30 or 35 when he became a master or chief engineer, I'm sure a lot of people still may be becoming a little earlier. But if you did become and you continued with the same salary, then in just next 10 years, you could go from 9.5 crores to 30.4 crores. This is a figure which even I'm finding it difficult to read out on the screen, but that is exactly what will happen. You'll probably have to buy a better calculator. You won't be able to calculate those figures, and we are only talking about the minimum salary which happens for a uh, person who's sailing on a dry cargo, which probably have the lowest of uh, rates. Now, it could be a person sailing on an Indian ship, paying income tax and everything. If I am not audible enough at any time, you can please unmute yourself and you can let me know. So now the second page of this workbook, the second sheet, talk first was about your saving, that you saved and you invested. And the second sheet is that you retired. And suppose you retired at the age of 50. Now, every year I calculate taking a lot of factors and a lot of surveys into picture. I ask a lot of people of different age groups, and they let me know that how much are the expenses. I ask a lot of housewives of different strata of the society that what are the home expenses in different cities, and I come to a figure. So the figure that I had kind of declared last year was 4 crores 80 lakhs if a person wanted to retire at the age of 50 last year. And this is a figure that if you invested 75% of it in equity and continued with it, I will answer that question if you ask me that how can we keep such a high amount in equity? I will answer that question also. But we are not even talking about what you are actually saving by the age of 50 or by the age of 60. We are just talking about a general theoretical figure that I had said you need this 4.8 crores if you were 50 last year. 75% of it invested in equity mutual funds and 25% in fixed income assets like FDs or debt funds and things like that. Strategies which we can discuss later on. But the idea is that from this, if you again continue to get just 10% return, again, this is a CAGR. CAGR means that when you will calculate it over next 2 years, 3 years, 4 years, 5 years, it would give you an average of 10%. And I'm assuming just 10%. We're not even taking into consideration the 15, 16% which we have got and which we are expected to get for next 20 years. And that is a fact. So we are saying that what he's earning out of interest or capital gains at just 10% is this much. And suppose he invests in the mutual funds and the rules remain same, then he's going to pay 10% as his capital gains tax on equity, and 10,000, 1 lakh is the standard deduction as of rules today. Rules, as you know, keep changing. The next column, F column, shows what he will have gross in hand at that end of particular year, and what, as per the inflation, will be his expenses. Now, these expenses for last year is 18 lakhs, which is about 1.5 lakh a month. Though my estimate was 2 lakhs, but I was told that no, 1.5 lakh is good enough even in Mumbai. And this does not include any large ticket expenses like children's weddings, or we assume that when you retire at the age of 50, most of the education of children is over and you're not going to pay out of it. Naturally, you will not like to retire unless your children are settled, at least in the language of our land. So gross in hand was 44 lakhs 20,000 and your expenses were 18 lakhs. Your net capital gains in that year is 26 lakhs. And your grand total immediately at the end of 23 becomes 5 crore 6 lakhs. Now, I don't have to go step by step, but you can see that every year, just that amount is getting reinvested. From I, for next year, becomes a principal. From this column, it goes in this column and becomes a principal. Again, 10% you gain on that. And again, you pay your 10% on the expenses, whatever you redeem. I have assumed that whatever you are actually capital gain is incurring, you are paying tax on the entire thing, assuming that you are actually taking out the entire thing, but which is not so. You're only going to remove what your expenses are. Like it was for 18 lakhs, you will withdraw 18 lakhs. So there is a flaw in this chart, which I will try to take out. But this flaw is in your favor. Means I am assuming the highest point of tax rate for the entire salary. Suppose some worse rules happen next year. So you see what happens and how this grand total in the I column keeps changing from the age of 50 up to the age of 60. You go from 5 crore 6 lakh to 8 crore 28 lakhs. And like I said, I have taken, because tax and death are something inevitable. They don't leave anybody. And I could only go up to 78. And I said, after this, there is no really requirement, because even at the age of 78, in the next 28 years, you're going to have 14 crores with you, with the corpus that you already had. And your expenses are going up. They are just following the way they were. So from here onwards, of course, a lot of things could happen. We are not really taking them into consideration. But the idea is that just like you have a small snowball, you have a hilltop, a mountain, and you see that there's a small piece of snow which breaks from the top, and it falls and it starts coming down. Now, as it falls, it picks up some more snow, and because of that snow, the new mass that is created, it again moves a little faster, and again little more mass it picks up on the way. And after some time, in about few kilometers of its downward travel, the that small piece becomes big and big, something what you see in the Hollywood movies. So this mass of snow, when it is moving, it has both weight, it has the velocity. This is exactly what happens to your investment. As a caret, what you saw in the first screen, the first sheet of this Excel workbook, was what a caret starts saving. It is nothing, it's pittance. But as he keeps growing with that, two things happen. First thing is that he gets into the habit of saving. And out of that saving, he gets into the habit of investing. With that investing, he comes to know about things which are happening in the world, in the field of industry and various things. So his mind opens up, and he realizes that wealth is generated in this way because of the industries which are around me, which are where all this thing is happening. Uh, if I am audible to you, kindly type out a message here and let me know. Right. Thank you. So the point is that it's a very gradual process. A person who was just out of the college, engineering college, or is out of the nautical college, and he has gone on board, he has all the theoretical knowledge. Probably at this stage, if he appears for a master's exam, he would pass absolutely within no time, even for extra masters, because his theoretical base is complete. But he is absolutely unaware about the world. So when he moves on board, when he goes on board, he starts saving, he starts investing. When he starts investing, he gets interested, and he starts reading more. So the idea is that he grows in personality, he grows in attitude, he grows in his general outlook of life. With that comes stability. He sees that his funds, which were like 10 lakhs till yesterday, today due to market crash have become 8.5 lakhs. But he knows that they also can go up as fast as they can come down. Hi, John. Welcome. So basically, this is the way a person matures. And it is that maturity which helps him get over in life. This is a term which I learned in Vipassana. And a second time I heard from my batchmate who's here, John. It's called equanimity. Means you should be steady in your uh, approach, in your outlook in life, that yes, it has fallen, doesn't matter. It will go up also. Now there is so much of a racket. Everybody is asking about Adani in the market. What happened? This, and so many lakhs and crores of wealth has been eroded. I really don't know whose wealth has been eroded. How many people had actually bought Adani shares? And if you actually go back to your uh, what do you call returns, you will see that they're exactly where they were earlier. There have been actually no change. In fact, there are large cap funds which have even given 16% returns. And everybody on the TV, they earn their bread out of scaring people and making them panicky. So the whole idea, as we have gone over this Excel sheet in like what I shared just now, it is to basically motivate people to start fresh. I know that cadets and junior officers going on board need to be motivated, need to be taught, but it is the same with senior officers also. We have so many people who write to me personally and saying that I am a chief officer, I'm a master, I'm a chief engineer, but still I've never invested in anything except real estate and FDs. Because that was exactly what we were taught from early on. So the whole idea, like what I always see, is that there are few steps on how to succeed in any particular thing. First is listening. What we are doing today is listening. But listening should either convince you or it should distract you, taking you off from the whole idea and say that it's not really working out. So, second thing which should come is inspiration. That I listened and I was inspired, and that inspiration should actually start making you think that what was said, does it make any sense? Is it logical? Is it practical? Try to check it out on the resources, various resources. I'll give you the names of few resources which I consult very regularly. I have been doing so for last quarter of a century. And then, of course, once you've thought, then you decide that, yeah, this is fine. Now I must do it. And the motivation to do it should be so strong, like I have often been mentioning in that Telegram group, that there was this fourth engineer who was signing off from on board. He joined the group while he was on board, and he was so motivated that he came from a very small place in Jharkhand, I think not Bihar, Jharkhand. And the closest, biggest town to his place was Varanasi. So he asked for a flight, or maybe he was getting a flight up to Varanasi, and he got down. And I tried to connect him to the nearest CAM's office. There he went. With a very modest amount, he started his, which of course always is 5,000 rupees. He started his first investment. There itself, he started a SIP also, and then he went home. Now, that is the best thing which can happen, because once you go home, there are so many things to be done, both at the personal level and professional and academic level. You have to book for courses, you have to do so many things, and of course, take some holidays and sit with friends and family. It was certainly not possible for him to come back to Varanasi and start investment. And we do appreciate that, it's not really an easy task since we all have signed off after a long time from ship. Now that is decision making. And after that decision making, once you decided and you executed like he did, the most important thing which comes is staying on the path. You have to follow the path. You have decided. Now there should be no looking back. There can be variations. There can be slight modifying the path, that this fund is somehow not doing so well. After a few years, you might realize, no problem. At that stage, that particular fund, you can just stop investing anymore and start in another fund. We don't know which fund will do well next year. The best fund today will certainly not be the best fund next year. This is for sure. That you can always be assured that this fund will not do well next year. And the biggest example we can see is the Parag Parikh Flexi Cap. Before that, also, a lot of things have happened, a lot of funds which were chartbusters, but we are certainly not in the victory game. We don't want to be with the fund which is number one. We want to be with the fund which basically it gives us returns beyond inflation and which can cover the taxes. And beyond that, if it can give us 5 to 7% return, it is very good. Right? And the most important factor, like what we see here, is that why only mutual funds? Because your taxation is most efficient amongst all the asset classes that we have seen so far. Of course, gold is little beyond the this thing people right now, but nonetheless, it is there. So after you have stayed the path, please do not watch any CNBC. It is not required. If somebody tells you that the market has fallen, your best reaction should be, "Oh, really?" and get back to work. Our work is not to dabble in the market. Our work is not to evaluate companies and 50 companies to decide on two companies. Our work is to perform our functions on board. And this is a very important function. What you're doing on board is probably four times tougher than what I was doing in my time as a junior or even as a senior engineer. For the simple reason that the people today on board are about one third of what they were when I was a fifth engineer. So you're doing something very important there, and you should excel at that. The more brilliant of you should actually educate yourself to take up higher functions, not only in shipping. You can go to other uh, businesses and industries and do well there, as a lot of people have done. You will come to know about most of them. But the idea is that you must know that what your money is doing, and it is working for you. It is working day and night for you. When you're sleeping, when you're taking a holiday, when you're on board, whatever money you have invested in mutual funds, it is working for you. It is not going anywhere. And so that is the whole idea of this seminar. And for a lot of people, a lot of you who are here, you may have already started this journey. So it may be a repetition, but nonetheless, you can still see. Something that we would go around now doing is we will take a view of all the uh, uh, aspects that we have in selecting funds and how to go about. So before to show you the list or anything, I would like to tell you that nowadays there is a kind of a fad where we use these apps to invest. I am not really against these apps at all, and they are just fine. But the problem with these apps is that most of them they make you invest in a demat form, and these demats they say that we are zero cost platforms and we do not really have any interest on in your investments, but they do provide the services, and any service which is provided and is coming free must be doubted. Most of these apps, except for the name that I have learned on this group only, is Kuvera, where I also opened my account, which actually issues all the mutual fund which you invest in a non-demat or a electronic form. That means there are two ways of buying a mutual fund. One is on the exchange, that is just like your stocks, and another is directly with the AMC office. Whenever you buy it through these apps, like I said, or in any other format, in a demat form, those mutual fund units they remain in the demat form. And sometimes some of the demat companies they also charge you for the demat fees for liquidation. Whenever you sell, they'll charge you for that, and a lot of other ways. So, in my opinion, when we have an option of directly investing with the company, then why should we have any intermediaries? There is a website of the mutual fund company. There are two entities called CAMS and KFinTech who take care of all the paperwork and holdings of the investors and reply for everything on the behalf of the AMC. Most of the time, it is the AMC, if you write to them, who will reply. But CAMS and KFinTech are the basic entities or called RTAs or registrar and transfer agents. So this screen, which I brought up, is basically this shows all the mutual fund categories in the Indian mutual fund industry. Right now, what you're seeing is a hybrid. Above this is the debt, and beyond this is the equity. Out of this equity, incidentally, I've also made a video for JMDI. I'm sorry, this much annuity coded on selecting your initial funds for investment. That would also be released, but I'll just go over with you how to evaluate this forum. So this is value research, as you can see, and what you're seeing is basically my one of the portfolios because you can create as many portfolios you want. You can this is how it looks like, and here you can log in. You can create your login. The login would be free, of course, and unless you are asking for some premium services, or you'll be getting a whole load of data here which you can utilize for yourself. You can create your similar what you saw here. You can create your own profile, and you have a lot of these things which you can get your reports from. I have been maintaining my data in this for for a long time, and all my evaluation and my information comes from basically this single source. So I'll just take you quickly to this large cap because large cap is one category where you can start your first fund from. In the large cap category, now as you know, there are two type of mutual funds: actively managed, passively managed. Actively are most of these funds which you can see, but in the passively managed, you will only have the ETF and the index funds. What you can see here, ABSL Nifty 50 equal weight. So this is an index fund. ETF, again, you can have to buy on the exchange, which may be a little inconvenient for the mariners because they find it difficult to open demat and trading accounts because of various formalities. So I would suggest that skip all those things, everything, and concentrate on these index funds. This is the you must have gone through plenty of times, and this basically shows the rating, which you should not depend on too much. This shows 1 year rank, riskometer, category is large cap, VR opinion is value research opinion, which says buy, hold, sell, or no opinion. But this shows the expense ratio. Now, by going by the expense ratio, you can see that all these minimum below 1% are the ETFs because they do not require much of effort from the company. So these are all ETFs unless you go to the index funds where you can find that IDFC Nifty 100 index, or you have further on some index funds. So as your first fund, you can safely select a index fund and one from Nifty and one from Sensex. You can do from Nifty or Sensex, either of them, but I have seen a little variation. So for the sake of comparison, if you are a junior officer and you have money to spare, you can invest in both to compare for some time and then decide that which way will you go. I invest mostly in the Sensex, HDFC, Sensex direct plan. So otherwise, there are a lot of other things which you can, in fact, if you will click from here, the whole fund card for this company will open up. It will tell you everything that you require to know. We have clicked the wrong one. So the second company, which the second drop down menu, like you see the blue chip direct here. So if you will click the fund, you will get a complete fund picture, which you can evaluate on the basis of overview, returns, premium cover, risk, portfolio. You can actually get the portfolio, how many stocks it holds, if you are interested that much. Because see, it is a lot difficult to evaluate even 50 or 100 stocks. But when it comes to mutual fund, it's pretty simple. You don't really have to go that extra way to select your funds. So now this is what they hold. This is for a normal active fund. A index fund, if it's a Nifty or a Sensex fund, it will have the same stocks in the same ratio as they exist in the index. The returns are pretty simple for them, which you can also get from here. And you have a short term uh, performance. If you are interested in the performance, you have a long one also, which you can check from here. Portfolio, as I said, you can select each of those portfolios and you can select on your first fund. One or two funds from here. And then we go back again to the flexi cap category. The second category, which I would prefer to invest if I were to start off again, and which I did, even though in my time, FlexiCap was not really a, a category in itself, but there were FlexiCap funds. And I so happened to start investing in the HDFC fund, which was also one of the very old funds and has done phenomenally well. So you can select a FlexiCap fund from here. In this video also, which you will be able to see a few days later, I have pointed out a few funds in which Axis HDFC FlexiCap was one of the better ones. Axis FlexiCap is not doing so well for last 2 to 3 years, but please do not write it away. Canara Robeco FlexiCap, it's about 10-year-old fund, 10 year 2 month, because most of the direct funds have actually come into existence from 2013. So from here, you can select your second fund. HDFC. Most of these FlexiCap funds will come in two formats. One will be general FlexiCap, but the AMC also issues one fund for the focused mandate. Means they invest only in 30 or 20 stocks. Like we see Axis has a Focus 25 Direct. So similarly, HDFC also has a focus, but I would prefer that you go for the normal FlexiCap. ICICI FlexiCap is also a good fund, very recently launched, but you can be assured that the equity research team is very, very good. Apart from this, you have a Kotak FlexiCap, which has unfortunately ballooned out bit out of shape with 36,000 crores of AUM, but you can select it. Most of you must have heard me talking about Parag Parikh mostly, which has not been doing so well because not only because of the US stocks going down, but because it was not able to buy the US stocks because of the restriction of SEBI to not buy more than $8 billion of collective US stocks by the complete industry. Next is PGIM India FlexiCap. And this is how you can start off your investment. SBI FlexiCap Direct is better than SBI Focused, because SBI Focused again is invested to about 15% in the US stocks. So this is how a new person should start his investment journey. And how to go about it? It's very simple. The biggest impediment, the biggest obstacle for everyone today is the KYC. So even though the KYCs seem to be very simply done by the aggregators like all this Grow, Kuvera and all that, you can just do it. I could do the Kuvera KYC because my KYC was in place. But it is not so now. From 1st of February, in-person verification of every investor, whether he's a resident or a non-resident, is compulsory. So you will have to go either to that AMC office or you will have to go to the CAMS or KFintech office in your respective city. To go there, to start your investment, you just require your CDC, your passport, your last contract form. Last contract form is just a requirement. I mean, it's not a requirement, just to show that what your address of your employers was. Then your Aadhaar card, PAN card, and the checkbook from which you will be investing. Preferably, you should have a net banking operational on that account. You can carry your NRO checkbook also if you expect money, regular funds flowing into your NRO account. Then one fund you can invest from your NRO account also. In this particular webinar, we will not talk about the investment for the spouse, because that itself is a chapter which invites a lot of questions because of the taxation aspect. So we will take up in a different webinar. So this is precisely what how we should go about. And 2 index funds, 1 or 2 FlexiCap funds, they should be good enough to start even if you are a master who has not really invested any time into the equity market, or you have been doing your stocks. I am not against stocks, but I am apprehensive of them being followed by people because they require a lot of effort and the returns are not commensurate with the effort that you put. Means people have a portfolio of even 1 crore, but then 1 crore for a person who is earning 60 to 70 lakhs in a year is like he must definitely be keeping most of his money in the savings account, in the bank account, and waiting for an opportunity. Now, that opportunity loss can be huge. So, whenever you have decided that I will invest, please be disciplined. Start investing from the day zero. I say that your investment should start as soon as yesterday. So, please do that. And book in your SIPs initially if you are a little apprehensive for 1 year, and later on you can do it for a longer time. I have moved away from the concept of STP, about which I have written 2, 3 articles in Marine Insight and 1 or 2 videos also. And the reason for moving away from STP was 2, 3, because firstly, nowadays we do not get the NAV for the same day. And with the volatile market, it is possible that you have moved out from the source fund, which is normally a debt fund, on one day, but you will be getting the NAV of equity fund maybe of the next day when the market could actually be high. So there you lose the advantage of the STP. Secondly, whatever is the capital gains on your debt fund, which would not be very much, but for a resident, it has to be calculated and paid at the end of the financial year. But for a non-resident, even that is deducted at the rate of 30% right away, and then you have to claim back. So that is the second one. Third is, with the new taxes which keep piling on, like STT, like stamp duty, and things like that. So you do lose little bit of it. It's not much, but well, when we are talking about going direct for investing instead of the distributor and trying to save that 0.8%, everything should count. So there is no harm in keeping one account only for the purpose of investing, mutual funds or even other things, and keep a separate account for your bank account for your expenses. This expense account could be in your wife's name, a normal risk sharing account, savings account also. So that is the main thing, that this is the way you should invest. Preferably, all your savings should happen. I mean, all your investments should be outlaid by the 5th of the month. That was the way I used to do it. So that that amount is in your mind. It is already outset for investments. You would not have to worry about doing, should I not? SIP is not a magical trick. It is, everybody thinks about SIP and they think that SIP is a product. SIP is just a way of investing. It takes away the decision making from yourself, from you. And that is the best thing about it. That SIP is beyond any XIRR which can happen, which you will see in retrospect that no, this was not the fund that I should have invested. I would have got better in another fund. But you should not forget that had you left it in your savings account, you would have actually been running in a loss. As a NRI, you have a lot of advantage that your money is tax free at different stages. But we should also remember that we do not know when exactly. The uncertainty of our profession doesn't allow us to know that when would we be losing our status for whatever reason. And at that particular time, the taxation could actually be heavy. You cannot avoid that tax, but you can certainly, out of your amount invested, it is possible that you will be able to get so much return that you would be able to pay that tax. If we go back to that again Excel sheet, you will see that even if in those 30 years, it is impossible that sometime it will not happen out of accident, that you will not be able to maintain that status. But if the sequence, the flow of your funds has been moving continuously into your investment, I am very certain that in that particular year, you will definitely have so much of returns that you will be able to pay those taxes very easily. It has happened with me. It has happened with a lot of our colleagues who come back and say that, yes, the theory is correct. So we cannot fight the law of the land. If they want to increase this capital gains to 20% tomorrow, we can't stop them. If they start taxing the non-resident income next year, we can't stop them. But what is in our hands is to invest what we get. If you want to see that Excel sheet again, we are only talking about 30%. But tell me, captain or a chief engineer or a second engineer, a chief officer who are earning 40 lakhs to 60 lakhs, any figure. If they outlay just 30% of their income, and that is 20 lakhs, let's call it 20 lakhs or 18 lakhs, then what are they doing with the remaining 40 lakhs? So certainly when you are already investing that minimum required amount in your equity mutual funds, then certainly you will think at a certain time that why am I keeping all this money elsewhere? Why not invest more? So at a stage, even with children, even with family, even with buying home and everything, the time in merchant navy is again back where we can actually invest more to gain more. You have to build that snow uh, ball which will come down in volume. It is very difficult to build up that first 1 crore for a lot of reasons. First is mathematical. Second is the low salaries which you will have in the initial times. But there will come a time when this movement of growth of your corpus will not be linear. It would certainly be, it will be in a an exponential way. You will not be able to understand that how this happened. I mean, I am here and I could quote my figures at different stages of my life. I have a very, very clear memory about how much I had at different stage of my life. And in 2010, when my daughter went to college, my total corpus, inclusive of my, because I had moved out of all my fixed deposits, NRE fixed deposits, I had moved completely to debt funds up to 2012 when the bank rates were made uncontrolled by the RBI, means they liberalized them. So till that time, my corpus was not 1 CR. And till that time, I was about 46. In the next 4 years, my corpus, because of the meltdown of 2008, in which I did not stop. In fact, like I said, I moved all my savings from my NRE accounts and everything to debt funds so that my STPs could take place. But from 2014, 10 to 2014, in 4 years, I actually had to call off my retirement. So in that time, my portfolio grew about 4 times. After that, there was no income. And whatever was there, I had to manage. And I had assumed that this is the amount that I would need. But at no stage did I come below 75% in equity. In fact, the equity funds I started redeeming as late as 3 years ago. I first finished all my FDs. I never had a life insurance, of course. Then I had to close one of the PPF because it was completing its time. And I used all that. And much late, after that, I started using funds out of debt funds because I allowed my equity funds to grow. And I did sell a real estate also because one has to, when you buys a real estate either for consumption or for monetization. In India, unfortunately, the thing is that you have to, most of the time, we are selling and again buying something because of that cash component. I did nothing like that. I sold it complete white and I invested. And certainly, the way it has grown up, the way it has moved up, it is even surprising for me. And I assume that it is much better for you because this is the feedback I get from you and other people. We are just 40 of us here. But the feedback I get is sometimes so much that I can't even read all the mails, but they encourage me a lot. They give a lot of uh, confidence to me that yes, whatever we are doing is good. It has stood the test of time for last 26, 27 years, and it would probably stand the test of time for next 27, 28 years. And it is not a magic. I am not doing a favor to anybody. You are not doing a favor to me. You are investing for yourself, for your future. This talk is just to motivate you to do better, to do more, to not really move away from your profession. Our profession is to perform on board, and our dharma probably is, if you are a youngster, to educate yourself more and do better in life. I'm not saying everybody should continue to on board till one is 60 or later. You should do well. A lot of people have gone to Ivy League colleges and colleges in India, and they've done wonderfully. But that is our main purpose. If you wish to be a finance professional also, then please do not try to do it by trying to learning investing on your own. Go to a professional college, take a professional course, do it. and do it as a business, not for your money, to do it for yourself. Because then your objectivity will be hampered, subjectivity will come into picture, and most often than not, you will end up losing money. So that is about all that I wish to say. I'll read out this question from a cadet which came in yesterday. He says that I don't have enough money to invest. I am sailing and I'm coming from a very low middle class family and I have all the gadgets to buy. So how can I invest? Now, I have already replied to him, but I don't know if there are some similar people here. But the point here is that in the second chapter of economics books in schools, it is taught that wants are unlimited and means are limited. However much we earn, at some stage or the other, we will find that money is always less. So we have to prioritize. It is not necessary that the phone that I must buy should be an iPhone. It is possible that I can manage with a 12,000 rupee phone because most of the time, as it is, you are going to be on board. So, what is the point of buying the latest model of a car or latest model of a mobile phone or your MacBook when you can do with something lesser? Yes, you will start earning much more money in times to come, and you can defer it for that time. The most important thing, which is necessary to do, is that you have to start your investment yesterday. If you do not do that, then somewhere along the line you will lose out, and it will be very difficult for you to catch up with time. There is a small slide that I would like to share with you. I did this calculation years ago, and I was a second engineer at that time. So you see this. This is also a small chart here, and it shows, let's say, two of us. There are two of us as batchmates also on this group. So let's say he and me, and we say that both of us passed out from the college at the age of 22, and he started investing $100 right from the first month. And then again, after 5 years, we met for a chief's exams. And he told me about investment, that you should invest in this and you can get 12% return and it will be nice. So from the age of 26, I start investing. And then something happens and he stops it. He says, no, I've invested enough. So he stops after another completing 10 years. He just stops there. But I continue. So even though I'm continuing, as you can see, that at the end of it all, I will never match up to come to his level. And if he continued with his $100 right through, you see the difference, what he would. If he did, instead of $9,600, he would be standing at $13,333. But the idea is that these 5 years of our failing to utilize the opportunity and start the investment. I mean, for the next 5 years, we are doing the same way. But just those 5 years make all that difference here. This is just for the difference of those $500 that I missed out. And this has ballooned into almost $1,500. So this is exactly what happens. This is precisely what we should be wary of. We should not lose time. As I always say, we should start yesterday. So this is the answer to that cadet. And like I said, as we keep moving in life, we become more matured, we become more controlled. I'm sure you must have heard about that famous marshmallow experiment where there were a few children who kept the marshmallow for the next day to receive another marshmallow. And later on, over a period of 40 years, when they were evaluated, they did much better in life than the people who had actually eaten the marshmallow that very day. This concept of instant gratification and delayed gratification is what we should understand. Investing and what happens with that investment is for somebody else to see. You have already filled that application, you have written out that check, you have already locked your SIPs for next 5 years. But what is important is that you should have that same frame of mind. Tomorrow, when your corpus goes up to 1 crore, you feel very nice. But if it falls to 80 lakhs, you should not flinch, because that money which can grow can also come down. And the one which has come down is giving you an opportunity to again invest. It is the best time machine that I have ever seen. And this time machine only exists in the field of investing. When you're, suppose the worst case scenario of 2020 March, and your uh, corpus falls by 23% in a single day or maybe a single week, it is giving you an opportunity with the money that you have today to invest 5 years ago or 4 years ago, at a time when you did not have that money with you. I am not saying this for theory. I have done it in 2008 and 9. I have done the same thing in 2020. And in 2020, just outside in a lawn, I was having this webinar with about 43 of us. We are 41 today. And I was not aware what was happening on the TV. So we had decided that day that we will invest in the international funds also. And this is a time to invest in the existing funds. Whatever funds you have, just invest in them on a weekly basis. And most of the people who did it, because when I came back and I saw the television, I saw the market had melted away. So we just decided that day that now we should. That day, for some reason, we could not invest because when this thing happens, somehow the server doesn't respond and things don't happen. So this is a very important thing to understand, that when the market goes up and everybody tells you and you have a reason to feel happy, your best reaction should be, oh, all right. But also when it comes down and falls by 20%, you should say, oh, all right. Because that is the basic definition of risk. Risk in the field of investment or personal finance is that when you need money, which are the avenues that you will be liquidating? If it is this avenue of equity mutual funds that you will be liquidating, even if it at a loss, then it is risk. Or if you are liquidating, even at a profit, it is risk. I would suggest that you keep your fixed income assets if you are expecting that you will need that money to do something different. So you keep it in your fixed income assets, in your NREFDs, in debt funds, or whichever way you can keep. But these equity funds, with every small SIP which is added of 10,000, 15,000 per fund, because that is the level of SIPs that we are looking at when you become a second engineer, chief officer, or a master. We're looking at 50,000 or 1 lakh SIP into a single fund, divided into 5 parts. That is a weekly SIP. Because for what is SIP for us becomes actually a bulk purchase for the people who are earning on shore. So utilize that. And this is the only way that slow wealth will grow up and you will grow with your wealth. The second question comes from a third engineer who's already built about 35 lakhs. And he says, for how long will I have to go and build this? Well, I have already shared this chart with you, this Excel sheet. It is available on the FinWorld at Sea Telegram group in the file section. You can see. But in theory, from my point of view, you keep investing till 2 months before you retire, till you have the money to invest. And when you do not have the money to invest, you stop investing. And at that time, you start consuming. You start consuming from your fixed income assets before, your tax inefficient methods before, from your FDs first, from your all those post office schemes if you have invested in your wife's name, or whichever format, your debt funds. From those, leave the equity funds to as much time as possible. Whatever happens, the fund value, however much it falls, will never go down to a level that you started investing from. It can never. If you will check the fund called Nippon Growth Fund, it is another very old fund of the country, somewhere in line with HDFC Equity or HDFC FlexiCap Fund, which has crossed the NAV of 2000. Do you understand what I mean to say? That an NAV of 10 rupees in 1995 has actually grown to an NAV of 2100 rupees. It has grown 210 times, 21,000%, or is it 2100%? I can't even calculate. So that is the way things move. And these are the motivational things, basically, to keep you on the track, to make you understand that it is never going to be bad. It's always going to be good, because India is a growing country. We're not investing in this company or that company. That the person sitting in Bandra Kurla complex with his equity management team is deciding that where we are investing, and he's charging you only 1% of your corpus or what are you investing. So he's doing that. I mean, you may not be able to visit that office in your life, but he's already making you that money. People like Prashant Jain, people like Kenneth of IDFC, they have given far more money to the investors than what their own fathers may have bequeathed to them. This is your money. Moment you start investing, it becomes another earning member in the family. Even if your wife is earning, it becomes a third member of the family who is earning. And there will come a stage, it comes into the life of every investor, of every seafarer, that this third member called investment will give you more returns than your own salary on board. And this is the time when this happens with your corpus for continuously 3 to 4 years, that you find that my returns from my investment are far more than what I can from my own job. That is the time you can say that I am financially independent. At that time, you are free to take your decisions, of course, taking into view your responsibilities and liabilities at home. And that is about all. So, this is the answer for the third engineer. Now, Supriya had asked a question, and similarly, another lady had asked a question that our portfolio has reached 60 lakhs. She has mentioned this figure, that what are we expected to do now? Her husband is a master. So, in my view, if a master's portfolio is just 60 lakhs, you have not even started. So, you should just step up your investment, not with 10% what the financial advisors say, but much more. You should at least invest 30% of what your husband earns. It is high time you did that. I'm not aware which all other avenues they have invested, but looks like they were into real estate, in which case you will again have to monetize your real estate to put that money into the equity so that it grows. I am hereby claiming and advising you that equity outperforms even real estate in all matters, at least in the country, in India. So you can see your data, you can check your data, and you can decide what to do. There is another question which somebody says that he wrote in Hindi that मैं क्या करूं अगर market गिर जाएगा तो. So my point was that what happens जब तूफान आता है, when there is a storm on board, I mean at sea or even at home, uh, well, the smaller the twigs and all, they do fall. But what happens to the big trees? Does something happen when there is a big storm? Nothing happens. Or on at sea when we have a rough weather, we just stop the ship and wait for the weather to get better. It's the same here. You at that particular time, if there are difficult times, maybe you, if you do not have the confidence of investing more, you can just pause. You can just lower your investment. If you think that you don't have enough money to invest for a longer time, or if you feel, I have never felt in this particular way, that the market will fall further, then you can stop one SIP and wait for the time to little time so that you can invest in a lump sum. It is not necessary that if you have a SIP, you cannot invest in a lump sum. If your SIPs are on, but you still have money in the bank, if the market has gone down by 10% or 7%, you should make a bulk purchase. This is my strategy. This has been my strategy. Now, of course, for almost 9 years, I have not been earning anything. So whatever was a monetization of the real estate, I invested back here. There was a question here which said that how much NRE FDs should I maintain? In my opinion, as a particular figure, if you ask me, nobody needs more than 50 lakhs in the bank. If your most of the responsibilities and large purchases are over, that remaining money, instead of the NRE FDs, you can put in your debt funds. And this is especially applicable to people who are approaching the age when they should be retiring and they'll be leaving sea and settling down ashore. Because suddenly, one day, you will become a resident. You will be given 2 years if you have completed your 9 years previously for the RNOR status, when you will need not pay tax on that NREFT. But what happens after that? Suddenly, you will think that you'll have to make a bulk purchase of 3-4 crores, because there are people I know who have 3 to 4 crores in your debt funds. So, if not 50, make it 70, 75 lakhs, but more than that, always divert to debt funds. If you think that what debt funds to select, and how to switch between debt and equity, because again, when you move into debt and from there you want to switch to equity, there will be a capital gains involved, there will be stamp duty involved, there will be STT involved, and the works. So in that case, we again have a set of what do you call funds, which is which is uh, which is basically called asset allocation category. And right now, one of the funds which I have tested for myself for last 14, 15 months, even though I had a history for it for over 20 years, and that is ICICI Asset Allocation Fund. And why I refer to this is I have still not become in favor of thematic fund, but asset allocation funds are funds where you could actually, the fund manager could move from equity to debt to gold. And nowadays, some asset allocation funds are even going for your real estate. They invest in real estate also. So we can go on to queries because we are already about 1 hour, 7 minutes into the webinar. You can please ask your questions if you like. You can unmute yourself. Yeah, we have a question here which says if you can suggest some good debt funds and for how many years one should hold them. If you are going to follow what I just said, that you must invest your funds into this category, I would suggest that you go for the guild funds. And guild funds are the funds which invest in the government bonds. So they are sovereign backed. And there is a category. I'm still just, I lost the option at how I could share the screen. Somehow I'm not able to see it. Otherwise, I would have shown you. So the guild fund, one avenue where you can invest if you want to invest for more than 5 to 6 years. And secondly, where you can invest is in a dynamic bond fund. Dynamic bond funds, basically, theoretically, the fund manager gets a mandate of choosing whichever maturity papers he wants to. He has no bond, no binding. He can choose the government or the corporate bonds. And another one which you should keep your money in is the ultra short term bonds, ultra short term plans. If I'm able to get this online, I'll show you, I could have shown you. I shared my screen, but I'm not able to do that. Somebody could help me out with this. Suddenly this is gone. So these are the three funds, because I have basically invested in debt funds in almost 5, 6 categories, but that is because I have to do a lot of experimenting for your sake. But it is difficult to select debt fund. But if you go by these, especially the guild funds or government security bonds, then your returns will certainly be a little more than the FD rates which you get. Certainly. And if you will go for ultra short term, they will give you more returns than what you would get in a 1 year FD, 1 to 2 years FD. Right. So this is about debt funds. And which categories to go for, which AMCs to go for, these government guild funds, I would prefer that you take with either IDFC, HDFC, or ICICI. ABSL, that is Aditya Birla Sun Life, used to be a leader in the debt funds category earlier, but somehow of late it has not been doing so well. Okay. How many years one should hold them? Well, you should hold them for at least 3 years. If you are not intending to keep them for 3 years, then better let them be in your NRE account only, because they are tax free. Because if you will keep your debt funds for less than 3 years, then the taxation will be very different. So basically, if you will do it for less than 3 years, the entire capital gains which will arise if you sell it for less than 3 years will be added to your income. But if you will keep it for 3 years, then you will only have to pay 15%, 10% on that without indexation. And with indexation, it will be 20%. So at that time, you can do the calculation. So I would suggest that you should, if you keep in the debt funds, then keep it with the same perspective as your FD, just to diversify. And especially for the people, gentlemen who are like in the higher age group and thinking of retiring, or even the lower age group, they're thinking of taking up short jobs in India or elsewhere, where they think that they would lose their NRI status, they should move to the debt funds. That is my advice. And then, of course, they have a better choice of going for a STP instead of a SIP. Then there is one question that till now I have not any saving. How I start from SIP, as I do not know any ABC of it. There is a book that is there available on the Telegram group, which is called Financial Planning for Seafarers. Please read that. And after you have read that, uh, you can, I think you came in a little late. You should go over this video again. It will be shared immediately with you, and you can proceed in that particular way. In this seminar, I have categorically discussed that how exactly you will have to go to the AMC office or the CAMS office, RTA office, or the KFinTech office, and what to carry and how to invest. If at that moment you're facing anything, my number is available with you. You can write it down: 98086 40497. A lot of people phone me when they are going for the first investment. They phone me from the RT offices, and I let them know. I remind them about what options they should choose. In the chapter 8 of this book, you will find golden rules of investing. Again, I can't really share the screen with you for whatever reason. Otherwise, I would have shown you that particular chapter 8 of the uh, book, where I have clearly said what you should be doing at the time of your first investment and what you should not be doing. Then Ruben asks that is there any criteria for choosing an AMC? Yes, most certainly it is. And the criteria which should be, it should be about the pedigree. That means, will the fund last long enough, the fund house last long enough to serve you? And what is the view of the fund manager or the view of the AMC about its fund manager? And will the fund manager leave? There have been cases like IDFC, like SBI, where the fund manager has left, and after that, the whole fund house has floundered. So, in this particular series, if you want to select any AMC, you first have to see the category. And like we have already discussed today, that the large cap category, you have to invest in the index funds. So, these index funds, you can select from any of the category, but see that the fund has some good corpus. And one of the best ones in this line are Axis, DSP, HDFC. ICICI is, of course, one of the very good fund houses, which has given beyond excellent return, even for the last year, when most of the large cap funds gave less than 6% return. IDFC, Invesco, Kotak, Mirai Asset, Motilal Oswal has a very good fund, mid cap fund, which performed very well last year, but it does not mean that you jump on it and buy that. Nippon India was earlier called Reliance, and ever since our friend uh, Anil Ambani showed his colors, it was taken over by Nippon Company, and it is again coming back into picture. Then we have PGIM India and Parag Parikh FAS. This has got a good, it's got very few funds, but most of them is a liquid fund from where you can take the STP into your flexi cap fund. Next is the quant. I'm going in alphabetical order. Quant fund has been making waves because it has been giving excellent returns in the past 3 years. But we should also remember that this fund house is very new. It has taken over another very dubious fund house called Escorts. And now most of the schemes have been basically changed from that perspective. They do not have a buy and hold strategy. So quant funds are good as not core funds. You can invest in them, but not with a lot of amount, just to give a little boost to your portfolio, because they still have to prove themselves in a bear market, which hasn't really come so far. They have given excellent returns in 2020 when the world was actually undergoing a lot of travesty, I mean, a lot of problems. And so we don't really know how they will do. Beyond quant, SBI, Sundaram has somehow fallen off. And with Sundaram, I would just stop there. I would not even go to Tata. It has got good funds, but if you can do without that, I would be okay. So there are about 12 fund houses that we have discussed right now from the 48 odd that we have. So these are the fund houses that you can select from, but then it depends which fund house you are talking about. Please suggest some equity fund for beginners. Well, Harish, you have come in a little late. This is exactly what we have discussed in the beginning 35 minutes of this. But you are already investing in index funds, and I hope they are large cap index funds, that is the Nifty 50 or the Sensex 30 fund. So that is fine. You please continue with this. Depending upon what your rank is, increase your investment as you can. As you get more and more confidence, increase. But do not let go of your systematic method. Always follow your systematic method. Even gentlemen, suppose you come in into a good money, like a few lakhs at a time, or you feel that money has collected at a time because your SIPs were less in number and you have about 20, 30 lakhs which you can invest. I do get messages like this. Please do not be, uh, uh, I mean, disillusioned by whatever money you have. Always invest in steps. If you have 10 lakhs and you do not want to do SIP with them, no problem. You invest about 1 lakh this month and see how it goes, and invest 1 lakh next month, and try to extend this 10 lakhs to at least 4 to 5 months, if not more, because you never know that how much the market will fall when. So when it is not about how much pain you will see if you will think that I should have invested now. That is not the idea. The idea is that your money is going to give you chance to invest. So as long as you're on board, instead of doing all that stock trading that we do, this is sufficient enough. As you know, that market today itself, it has gone about 1.6%. Now this is a kind of situation which can happen once in a year, twice in a year. And if that at particular time you're not in the market, you've lost it. You could be there for 10 years, but if you're out of the market for that particular 1 month, you've lost it. So do not go into that concept of profit booking. This profit booking doesn't exist in mutual funds, because that profit is always plowed back. In fact, you don't even come to know, but in the whatever dividends that are received in for the stocks by these mutual funds, they're invested back into your funds. So that is how the NAV keeps moving up. So, Harish, please go on with your index funds, and you can select 1 or 2 flexi caps, as I had said. And if you're already done that and you are good on your portfolio value at about 50 lakhs or so, you can add a mid cap or a small cap fund, which you can ask me on the group and I can put it there. Sergi, something apart from what you're talking today, can you suggest me some good commodities fund? I have actually not studied these fund very carefully, but I did try to invest in gold funds in some time, and it did not work out very nicely for me. And maybe because I was investing in DSP Gold, which actually invests in the gold refining companies. So it was not working out very nicely. So it is better. The idea is that, why do you want to go for commodities fund? There are a lot of things in the market, but just because a lot of things are there in the market doesn't mean that we should go for them, that we should opt for them. It is not required. The idea is to get your 15% return or 20% return on your investment, which you are getting out of equity. If you want to diversify in terms of geography by investing in the international funds or Parag Parik, you can invest in them. So you have a diversion across that place. Then I will try to find 1 or 2 funds which have a mandate where they can invest in commodities. But like ICICI Multi-Asset Fund, it invests in gold also at times. So invest in that. Even last year, for 1 year, multi-asset fund has given you 17% return. I mean, for a multi-asset fund, it is unheard of. How can you get such a good return? If my friends and colleagues and batchmates in the developed countries, they hear about these returns, they don't believe it. But that is about all. But yes, I can try to do some research and commodities fund and let you know. But right now, at the moment, I do not know of any. And whatever few, I get to meet the fund managers who come to Dehradun, I somehow come to know and I go and meet them. Nobody has actually pushed these commodities. And they themselves, they say that the biggest regret that they have, the fund managers, that they started investing in equity too late. This is even the regret of this lady of Edelweiss, CEO of Edelweiss. What's your view on investing in PMS schemes? Are there better returns than MFs? Uh, well, I am in favor of MFs. And people have said that some PMS have returned more, given more returns than the MFs. But there are few things which cover this, and one is the taxation aspect, because it is not very clear in the Income Tax Act whether the earnings from the PMS will be considered as business income or as capital gains. So there is a very difficult way to select. And then, of course, now the fee of this PMS has come down, but the corpus, minimum corpus, has gone up. So, in my opinion, please hold on to your horses and stay on the track for at least till you achieve 1 CR. Once you have achieved 1 CR, it will take a few years, even as per that Excel sheet. So let's go to minimum of that Excel sheet and see that you're going to be in a one CR category. It will take you about, uh, it will take you roughly the age of 34. At the age of 34, you will be seeing your 1 CR if you went by this plan. Of course, I hope it is much earlier than that, because you'll be getting more returns than 10%. But after 1 CR, you will develop your own maturity to see if you should try out your PMS. By that time, you will have sufficient money and you will not flinch at 30, 40 lakhs being given to a PMS. You try it out and share the results with us. Some people have shared the results with me, but they have not given that much good returns. And another important point is that in this case, in the PMS, all the capital gains, they are added to you. So that is deducted from your returns, which I don't know if they are taking into consideration or not. Another very important thing that I want to tell you about mutual funds is, as against the stocks that people trade in or they invest in, that when a mutual fund buys the stocks, even quant mutual fund who says that I will buy and sell the same stock 3 times a day if I am making profit, the mutual fund doesn't pay any capital gains or anything which is deducted from there. It is exempted from that. All the same, if you bought and sold a stock, you will have to pay your capital gains. That means moving out of the stock, you will have to pay the tax on that. So this is a very important aspect of mutual funds. And second thing is about the dividend. Like I said, if you get dividend on your on your stocks, they are taxed in your hands. Whereas the dividend which are received by the mutual funds may be taxed to them, but they are added into your NAV ultimately. So finally, you get an expert management of your funds. You get the expertise of the fund manager, his personal bias, of course, but the full equity investment and research team. So that is what you should go for. Later on, if you feel that PMS is good, you can do it, but not in the earlier years. Because if your experience is not good, you might just be weaned away from equity forever, and which is not a very good thing, which happens to most of the people. Max return I can achieve is not more than 8% in any of the schemes related to government. Yes, at the moment. But this 8% can go down also. When I said government mutual funds, that is not the same. They will always give you a little more, 1 to 2% more than your FDs or any government scheme which is available. And it is the same way, those mutual funds are equally sovereign backed. The guild funds or the government securities funds, they are termed in these two names only. So that is not a really our view. They are safe and you can use that. What is the max limit assumed for investment exposure to particular category and particular fund? It's a very important question. And I have suffered on this because with time, in about 14 years of my 14 or maybe more than that years in HDFC equity, my corpus in one fund itself had grown more than a crore. And I was not even aware of it because I became busy with, after retirement, I became more busy in interacting with all of you. So it just slipped my mind. I mean, I hope it slips all of your minds and you get 1 crore corpus in all your funds that you have. But it did. And then its performance started falling. So much so that in 3 consecutive years, it was at the bottom of the category. And that was also the time in 2018, after 2018, when the capital gains tax kicked in. So even though I did it in a small way and I started withdrawing in small steps, but it became a very difficult decision to take, especially with this 10% category tax which is there. It is very difficult to change funds for sake of bad performance. We don't know which fund will perform badly extended in an extended way. Finally, HDFC Flexi Cap started doing well, and in the last year that Prashant Jain left the fund, who was a star fund manager of the country, he actually did a wonderful job. But I did realize that we should restrict. So at any given stage, I would say that try to move as many funds you have, try to move in a percentage way, keeping similar percentage in all funds approximately. Unless you are keeping having mid cap and small cap funds, which always should be little less. A mid cap uh, allocation in your portfolio should not be more than 20%, and a small cap should not be more than 15% in your portfolio, not fund wise. So I would say 60 to 75 lakhs in the beginning is a good figure to put your cap in a particular fund. I am using that cap right now, but if I am on the consumption spree, I don't have any earnings. So certainly, I will make sure that my fund doesn't go beyond that. But I'll keep withdrawing. PMS is portfolio management scheme, not government scheme, supposed to be more aggressive. Yes, of course, I said that. We'll like to add the best of the PMS have been doing a poor job like Marcellus. Thank you for saying that. A relative of mine stays in the same floor in the same building as Saurav Mukherjee. Saurav Mukherjee is an excellent writer, but I'm telling you that it takes a lot of effort to create returns, even for these fund managers. But these fund managers, they stand a very big advantage. And that advantage is that they have a large corpus at their hand. And even if they keep just 2% in cash with them for meeting the redemptions which you want to make or making fresh purchases, they have that possibility. But most of these PMS are not. Another category of similar to PMS is the AIF category, alternate investment category, which has three further categories, category 1, 2, and 3. Out of that, the second category is also formed like mutual funds. But in that, you do not have the regulation like we have for these active mutual funds. In an active mutual fund, no fund is allowed to have more than 10% exposure to any one stock. You cannot have. So that is why your mutual fund will never be a multi-bagger, but it will also not lose money for you. That 10% is actually a safeguard for you. Whereas for these AIF, which are also like mutual funds and are governed by the SEBI guidelines, they do not have such caps. So they might only have 7 stocks or 17 stocks, and in different proportion. They may actually take all the stocks of the Nifty, but in different way. But even though they have the regulation from SEBI, they are guided by it, but they are not controlled by SEBI. So in case somebody asks me this question later on, this is just a reply about the AIF funds. There are a lot of other categories which are beyond our requirement here. So that is about the questions that we have today. And I hope we must have picked up something from here.